If you're a teenager and you're looking to start investing in the stock market, this video is for you. This is going to be a free step-by-step course teaching you how to get started investing in stocks. We'll go through everything you need to know, including how you can actually invest if you're under 18, as well as some of the best investments you guys can get into. Make sure you stick around and take notes because we're going to cover a lot of really important things in this video. Let's get started. So first, let's talk about an overview of what we're going to be covering in this video. First, we'll go through an introduction of what stocks are. Next, we'll talk about the important things you need to know before you start investing. Number 3 is I'm gonna actually show you how to get started investing in stocks. Number 4 is we're gonna go through custodial accounts, which are required if you're under 18 years old. Number 5 is we'll go through examples of different stocks you guys can buy. And then 6, we'll go through my final thoughts about investing if you're young. So first up is the introduction to stocks. Okay, so basically, let's talk about what stocks are, right? I like to sort of think of them as a piece that represents ownership of a fraction of the company that is selling the stock. So for example, if a company has a total of 1,000 outstanding shares and you own 100 shares, that means you own 10% of the company. In the same example, if you were to own only 10 shares, that would mean you own 1% of the company's assets. So companies basically sell stocks to raise money for their business operations. There are a lot of companies out there that are not public. They don't have stocks that are available on the stock market, but the ones that you probably are familiar with, those are public, and they likely have shares trading in the general stock market. So in a nutshell, there's basically 2 ways that you guys can make money by buying and holding stocks. The first is through dividend income, and the second is through capital appreciation. And on the next slides, we're actually gonna dive deeper into each of these 2 things. So what are dividends? Basically, dividends are money that a company gives out to stockholders for holding the stock. This is typically paid out monthly, quarterly, semi-annually, or annually. Now, the amount of money you're receiving is measured by the dividend yield, which is essentially the dividend payment divided by the price. So for example, if a stock is worth $20 and it pays out an annual dividend of $1, that means that their dividend yield is going to be 5%. You might be wondering, why would companies actually want to give out dividend payments? Well, it's going to be a percentage of corporate profits to qualified shareholders. And it's basically their reward to shareholders for holding their stock. An example of a popular dividend stock is going to be Johnson & Johnson. So right now they have a dividend yield of about 2.74%. And basically what that means is that for every share you own of J&J, you're getting about $4.52 every single year in dividend payments. That is based on the current stock price of J&J. This means that if you own 2,212 shares of J&J worth about $361,000, that means that you would earn about $10,000 in dividend income every single year. So yeah, as you can see, if you have enough stock, this can actually eventually turn into a reliable source of income as you build up your portfolio. Now, what's capital appreciation? This is basically a rise in a stock's price. And to make money, there's going to be some type of difference between your purchase price and your selling price of that stock. For example, if you buy a stock for $10 and you sell it at $12, that means you earn $2 in capital appreciation. That $2 is then going to be taxed as a capital gain. The reason why stocks go up or down in price is because of supply and demand. If there are more sellers than there are buyers, well, the stock price is going to go down. If there are more buyers than sellers, that means that the stock price is going to go up. Usually, if there's good news for a company, for example, if they earn a lot more than expected revenues, then that increases the number of people trying to buy the stock, which does mean that the price should go up. Now let's talk about compound interest, because this is a universal rule that is extremely important when it comes to investing in stocks. Compound interest basically means the combined interest of both the initial money put in and the money that you make from it, right? So it's basically interest on interest. We'll pull up a graph right now showing what compound interest looks like. You can see that at the start, the growth is relatively slow and flat, but as the years go on and on, the slope of that graph gets higher and higher, and soon you're basically growing at an exponential pace. The reason for this exponential pace is because of that interest on the interest. There really is a snowball effect, and this is really why investing for the long term is so important. If you guys are young and you're watching this video, just know that if you buy stocks right now, then historically, based on what we've seen in the past, it should grow in the long term. And if you can hold on for a long time, you will be able to take advantage of this compound growth. A really easy way to look at this is, let's say you invest $100 today. In that first year, you get a 5% return on your money, which means that that $100 grows into, $105. Now for the second year, let's say you also get another 5% growth. If you invest that $105 this year, are you going to make another $5? The answer is no, because you had that extra $5 that you made the year before. After a second year, you're going to be left with $110.25. I know that's a very small amount over what we had before. I know that the $5.25 is barely more than the $5 we made the year before, but throughout the years, that actually becomes bigger and bigger, and that's basically the interest on the interest. So the takeaway basically is you want to invest for the long term so that you can see compound interest take place. So now let's talk about finding your investing strategy, right? So there are different investing strategies for different types of goals. Now I've sort of oversimplified it in the slide, but essentially there's two different ways to invest. There's the growth/value investing, which basically is when short-term investors want to be active in the market. They want to trade, every day, every week, every month. And there's also dividend/passive investing. This is going to be for long-term investors that want to, just trade once, sort of hold that money, forget about it, and build generational wealth that way. I'm always for passive investing because I truly think that, based on the history of the United States and how stocks have moved, that's worked out really well for most people. It also takes less brain power so that you can focus your time and energy on increasing your income, allowing you to invest even more money. Yeah, basically for most of you guys watching this video, I assume you don't want to, spend the majority of your time researching stocks, stressing over what trades you're going to make. Most people actually don't beat the stock market this way. They actually lose. But I'll be pushing for you guys to invest more passive. Now let's talk about some of the very important things you should know. And I first want to talk about what really matters when it comes to investing. What matters is that you invest a small amount into safe stocks consistently. So we sort of call this dollar cost averaging. And by doing this, you're able to take advantage of compound interest and time invested into a stock. If you guys look at the graph on the right, you can see it really, really matters when you start investing. So as you guys are probably young and watching this video, you're definitely at a very big advantage. Now, what does not matter, right? Time in the market for the perfect time to buy a stock does not matter. You should not try doing that. Research has shown again and again that it is impossible to time the market. Even though you may think you are super smart, you probably cannot do it because you need to time the bottom of the market and you need to time the top of the market. It's very, very hard. Plus, a majority of the gains in a market over the long term come on single days, and guessing those days is just pretty much impossible. Another thing that does not matter is trying to trade and flip stocks all the time. Day trading is cool for a lot of people, but it's also not cool for more people. And if you want to pretty much guarantee winning the stock market, then I don't suggest doing that. Okay, so now let's talk about custodial accounts, which are extremely relevant if you are very young and you're trying to invest. If you guys are under 18 and you're watching this video, then just know that you cannot actually open up your own stock account by yourself. Instead, you're going to have to open up a custodial account, or rather, should I say, your parents need to open up a custodial account. This is basically going to be a savings account or a brokerage account that an adult can actually control for you, the minor. It works just like any brokerage account that someone over the age of 18 can open, but there are of course some limitations since it is technically owned by the parent until you turn 18. You can withdraw money as long as it is used for the benefit of you, the minor. And then like I mentioned earlier, this account is going to be passed into your control when you turn 18 years old. So definitely bookmark this part of the video and you can show it to your parents later. So now here's some pros and cons for having a custodial account. The pros are you'll likely have 24/7 customer support for your account, depending on what platform you're using. These are also very flexible. They're very simple to create. They're less expensive than a trust fund to create and maintain. Earnings are also taxed at the minor's tax rate up to a certain point. This is generally going to be a lower tax rate since you are likely making less money. And it does allow you, the minor, to fully take advantage of compound interest. Now, of course, there are some cons. So having a custodial account with money inside of it can reduce your financial aid eligibility or any other government aid. Any deposits are irreversible and the account beneficiary cannot be altered. And when it comes to custodial accounts, there are two different types, UGMA and UTMA. So UGMA stands for Uniform Gift to Minors Act. And this only applies to financial assets, right? Like stocks, bonds, and mutual funds. UTMA stands for Uniform Transfers to Minors Act. And this applies to financial and physical assets. That would include things like stocks, bonds, mutual funds, real estate, and jewelry and art. I assume most of you guys will be using the UGMA accounts because not very many teenagers do have physical assets like real estate and art. I want to really briefly touch on the power of compound interest before we continue with this video because it's that important. So first we have scenario A, and this is basically if you have a custodial Roth IRA that's maxed out into the S&P 500 with an average annual return of 10%. If it's maxed out since you're 18 years old, this is going to result in $3.5 million when you retire. In scenario B, we have the same account that started 1 year earlier, and this actually results in $3.9 million. So you can see investing simply 1 year earlier resulted in almost $500,000 more in your net worth. That really shows the power of compound interest and how big of a difference one single year can make. That's why after you watch this video, it's so important to just go out there and take action right away. Okay, so now let's talk about active investing. If you guys want to take an active investing approach, you'll need to know that you have to do a lot of research. I recommend investing at least 1 hour into any company that you want to buy, and you'll need to learn how to look for value in stocks through ratios, financial statements, history, all that stuff. For example, the P ratio, PEG ratio, PB ratio, and more. We won't really talk about these in this video, but I do have another more in-depth video going through all this stuff, and I'll leave a link to that down below. But yeah, overall, this is probably not the best way to start if you are a teenager because this does take a lot of time and effort to learn. I'd rather just encourage you guys to go out there, start a side hustle, and start making more money. Now, with a passive investing approach, you're gonna also want to do your research, but the type of research you're doing is not nearly as difficult. You'll be investing more into safe, long-term mutual funds, index funds, and ETFs. And essentially the main strategy here is dollar cost averaging, DCA. This is when you're putting a small amount into your investments over time consistently for a long time. For example, putting in $50 per week into an S&P 500 index fund, something like that. If you're looking at buying individual stocks, here's some good ones that have done extremely well. Of course, this is not financial advice. Apple and Amazon are two of the biggest tech companies. VTI, VOO, and SPY are 3 ETFs that track certain indexes, and they've done extremely well over the years. So now let's talk about how to get started investing. So if you're under the age of 18, you're gonna have your parents open up a custodial account for you. You can do this on platforms like Charles Schwab, Vanguard, TD Ameritrade, M1 Finance, and more. I'll be putting links down below to those platforms. And yeah, all these are very reputable platforms. Do your research before investing into anything. And of course, I recommend that you buy and hold safe long-term securities like S&P 500 ETFs. And then if you're 18 or older, you can actually open up your own brokerage account. And I'll show you how to do that later on in this video. So to open up a custodial account, parents are gonna need the following things: their social security number, driver's license number, employer's name and address, contact info, birthday, and social security number of the minor, and then also statement information for funds you may want to transfer. As a parent, you're gonna really want to start encouraging and educating your kids to start investing at an early age, teach them the basics, help guide them along, and open up a custodial account for them as early as possible because like we mentioned earlier in this video, the difference between getting started right now versus 1 year later is astronomical in terms of how much your portfolio will be worth in the future. If you guys are 18 or older, I recommend opening up a brokerage account where you can actually buy and sell stocks, preferably one that is very easy to access like Webull or Moomoo. These are both platforms that you can access on your phone. And right now, if you sign up for Webull or Moomoo, they actually are giving out a ton of free stocks. So I'll be putting links to those down below in the description. All you guys have to do basically is use the link to sign up, submit your application. It takes just a few minutes, set up a username and password, fund your account, get your free stocks, and then you can start buying stocks. There's also alternative investments that you guys can buy. For example, your education, your skills, coaching, mentorship, or even starting up your own business. These are all going to have much higher ROI than any stock, bond, CD, or even crypto. And I'll really emphasize this, but as a teenager, the best thing you guys can do for yourself is to start developing high value skills and acquiring education and mentorship. Take those skills, build your own service-based business, and drastically increase your income that way. This is going to make you way more money than investing in stocks right now. And yeah, that's why I'm so bullish on this. Even though this is a guide on how to invest in the stock market, I do want to say do that, but also invest in yourself. That is where you're going to get the absolute highest ROI possible. So now I'm going to talk about some of the brokerages that you guys can use for your custodial account. TD Ameritrade is a really good platform. Vanguard, of course, is a very, very good one. And M1 Finance is also a great platform that allows you to easily invest with their PI system. So with TD Ameritrade, they have a super super strong reputation. They have 24/7 customer support, no minimum open deposit, no contribution limits, no maintenance fees, and also a huge investment selection. With Vanguard, this is also a great place to open up your custodial accounts. They have tons of low-cost ETFs and index funds with some of the lowest expense ratios on the market. They have commission-free investing, of course. And yeah, this is another great choice. To open up a custodial account with M1 Finance, you're gonna need an M1 Plus account. This is gonna give you access to smart transfers. You can actually get margin loans of up to 40% of your portfolio. They have a high interest rate APY for your custodial checking accounts. They also allow you to trade crypto. There's no minimum balance to open up accounts. Yeah, this is also another great option. So now let's talk about some of my final thoughts. One thing you guys need to know before opening up your custodial account is that there are going to be taxes. So children actually file as part of their parents' tax return. So earnings in the account are tax-free up to $1,150 in 2022, and the next $1,150 gets taxed at the lowest rate of 10%. After that first $2,300, any additional earnings are taxed at the child's parents' tax rate. And yeah, overall, I think custodial accounts are really great. I wish this was something that my parents had set up for myself, but if you're young and you're watching this video, know that you are already way ahead of the curve. And if you do start investing right now, you're gonna have such a big advantage when it comes to your overall net worth in the future. Investing is a long-term thing. It also needs to be very, very consistent. So what I recommend doing is set up some type of custom schedule that allows you to automatically move money from your bank account to your custodial account. This way, you're basically just dollar cost averaging into the market. Open up that account as soon as possible to take advantage of compound interest. And yeah, like I mentioned earlier, just invest into safe long-term ETFs like VOO and SPY. If you do want to invest in individual companies, then you'll want to learn all the different metrics that you guys can use to analyze different stocks. And I know we didn't really go over that in this video, but I'm gonna leave a link to a different full course that actually covers all this stuff. It's also 100% free, so that link is gonna be down below. And beyond all this, I want you guys to educate yourself on investing into yourself and your own business. This is going to be the best return investment you ever make with your money, so definitely set aside some money for that. Anyways, I hope you guys enjoyed the video. I hope you guys got some great value from this video. Feel free to reference it at any time, since I know we did cover a lot of stuff. And if you're under 18 and you want to start investing early, forward this video to your parents. Show them that yes, you can get started investing early with custodial accounts. And yeah, all the resources that we talked about in this video are going to be down below in the description. If you got some value from this video, make sure to hit that like button and also subscribe for more content just like this. I make a ton of videos about personal finance, investing, and entrepreneurship. Thank you so much for your time, and I'll see you in the next video. Peace.